On this episode of Passive Real Estate Investing with Mavericks, I sit down with Joseph Gozlan to uncover the opportunities in market cycles.
Hey Mavericks, this is Ava Baukamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Maverick, noun, unusual person, a visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
Welcome to Passive Real Estate Investing with Mavericks, where we provide actionable steps for you to grow your passive income and become job optional. During this episode, we're going to uncover the opportunities in market cycles. For those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Now, before I introduce you to today's Maverick, I want to make a request that at any point during the episode, you like what you hear, well, give us a thumbs up and be certain to subscribe to the show. Never miss a valuable episode. If you love what you hear, give us a written review. Plus, be sure to look at the description of this episode. We've packed it with thousands of dollars in free resources. Now, today we've got the privilege to learn from a person who has owned and operated more than 500 apartment units. Prior to his career in real estate, he was a software engineer. Ultimately, it all changed when the opportunity to relocate here to the United States and eventually got turned on to real estate. I would describe today's Maverick is somebody who's absolutely beyond passionate about real estate and pretty much only about real estate. Let me introduce you to today's Maverick. I've got Joseph Gozlan here with me. Joseph, how are you?
Hey, how are you? Thanks for having me on the show.
I'm great. I appreciate you being here. Say, for the audience's sake, maybe just tell us, who are you? Where are you from? What do you do?
I am from Plano, Texas, which is a northern suburb of Dallas. And I am a lot of things, right? We are vertically integrated. So first and foremost, I'm an investor. We invested anything from residential to multifamily to commercial real estate, like industrial and so on. So first and foremost, I'm an investor. And then I'm also a real estate broker and I own a property management company. So we've done a lot of things in the real estate space.
Sure. Yeah. Tell me, let's go back to the beginning, the very first commercial property in which you purchased. What was it and where was it?
Yeah. So back in 2015, I kind of made the decision that it's time to, if you want to call it, graduate from the single family and the duplexes and so on into something larger. And then I do have an engineering background in my previous career before I switched over to real estate. So I started researching everything, right? What is out there in the market? I looked at even stocks and commodity and all this kind of stuff. But really, real estate is the thing that made the most sense. Kind of different real estate and what's the next level up from your regular residential real estate. And multifamily was the most thing that made sense back at the time. So my first commercial sized property was a 22-unit apartment complex.
22-unit apartment complex. How did you source that deal?
Ooh, that one was interesting. So I tried the usual way, reaching out to commercial brokers, but a lot of the commercial brokers really don't have the will or the energy or the attitude to work with first-time investors in the commercial world. So it was really rough. But what I did is kind of said, well, I'm a licensed agent myself, so why don't I just go out there and source it? So I did yellow letters, I did postcards, I did cold calling. And that one came through one of the postcards that I sent.
one of the postcards you sent. Do you recall the unit mix in there?
It's a 22-unit apartment complex. So probably I'd say 60% 2 bedrooms and the rest are 1 bedrooms.
Yeah. What did you end up doing with that property? Do you still own it today?
I still own it. Yeah.
Yeah. How do you manage that?
We actually, like I said earlier, we own our own property management company. We managed over 500 units up until last year, but we sold a lot of our multifamily holdings late last year.
Sure.
So this is the last one we have standing.
Cool. Bring me forward. Tell me about your most recent commercial deal.
The latest thing we did was last December, we picked up an industrial property. It's 15,000 square foot, has a single tenant, triple net in it. And we've done that strategically. Like I said, we sold most of our multifamily. The way the economy is going, we felt that triple net. And if the audience doesn't know what triple net is, it's basically when you transfer the cost of your property taxes, your insurance, your maintenance, your materials over to the tenant. And that's included built into the contract. So we felt that with the inflation going out of control and costs of everything going up, it feels a safer or a more lucrative opportunity to look for triple net leases right now. So it was between industrial and retail. We kind of love the industrial space for a lot of other reasons. So that's what we went with.
So you bought that one, and did you 1031 into that?
Yes, we did.
Based on the exit of your multifamily?
Yes.
Got it. Did you put debt on that or not?
Yeah, absolutely. We believe in go as big as you can, as the better that you can, and leverage it up. So I tell my investors and my clients, real estate is like wine. If you buy a Walmart box of wine for $7.25, 20, 30, 50 years in the future, it's still going to be crap. But if you buy a really expensive bottle of wine today and you put it in the cellar for 50 years, you have a great investment on your hand. So I'd much rather buy a better quality property at a better quality location, even if it costs me more and I'm going to leverage more, because 50 years from now, it's going to be a way better asset than buying a lower quality property these days.
I like the way you said that. Immediately, the easiest way to make that comparison for folks out there, or at least for me in my mind, is you can go buy a dumpy single family rental property. It produces cash flow, at least on paper, a lot right now. Or you could go buy a brand new house and it would be poor from a cash flow basis. But you expand that over a period of years, or a decade or 2 decades, they're going to look very, very, very different.
Yeah, absolutely. And I like how you said on paper, because real estate has that weird thing about it that the crappiest the neighborhood and the crappiest the property, the better it looks on paper.
Mm-hmm.
But what people don't realize that on paper only looks at OPEX, operation expenses. So yeah, I get this much rent and I bought it for this much and it's 1%, 2%. Everybody has those rule of thumb. But what they don't realize is when you go to the rough neighborhoods, when you go to the war zones, then your turnover is much more frequent. You're going to have to evict. You're going to lose rent. Sometimes you need 2 German Shepherds and a shotgun to go collect rent, right? And the wear and tear on the property, the amount of money you're going to spend every time you turn a unit is going to be coming out of your pocket. And that doesn't show on paper. Because on paper, everybody just look at, oh, okay, I'm going to pay this much. I'm going to get this much in rent, and this is insurance, and this is taxes, and a little bit for repairs, but they don't take a look at the turnover.
No, you're exactly right about that. And real estate at the end of the day is about making money in real life, not on paper. When you've been there, done that, and understand the nuances, it does not shock me that you've made some of the moves you have into the industrial space, which for what we do, we absolutely love the industrial space. There's a big gap in between, from a time-wise, between your first deal and your most recent deal. And I'm certain that means a lot of lessons learned along the way. What are some of the biggest lessons you learned in between those two?
Yeah, so real estate has that thing that everybody thinks we're in the buildings business, but we're really in the people business. And this is one of the lessons that you're not ready for when you're young. But I got this advice maybe 15 years ago, and I was not ready for it. Yeah. But now I get it, and I give the same advice. And it's nothing people can sleep in. And it's an advice that I got 15 years ago. I was not ready for it. I had to go through a lot of blood, sweat, and tears in order to get to the point where I realized, okay, if the choice is a 100-unit apartment complex that have 200-300 residents in it, or 5 business owners shopping strip, I want the 5 businesses shopping strip. a lot less headache, a lot less complaints, a lot less regulatory risk in terms of rent control, the moratorium eviction we all had to go through in COVID. So this is one of the biggest lessons I learned is kind of like, I'd rather go work with business owners versus residential tenants.
Not something people sleep in. I like that. Tell me, what's your investment philosophy today? There's a whole bunch of opportunities that could present themselves. What makes an opportunity a deal for you?
Okay, so today in 2023, when we record this, right, the way we look at the market is we're headed to some rough waters. How rough and how long, I don't have a crystal ball, but I know that our cost of maintenance, our cost of labor is going way up, way fast. And I don't see that changing next year. 2024 is an election year. So more than likely, both sides are going to push for more spend. So we're not going to see any improvement on the inflation and stuff like that. So the best way to protect us from inflation was what I mentioned earlier, is the triple net leases.
Mm-hmm.
So we're looking at industrial, flex, retail, not all retail, but some retail, things that kind of give you the triple net leases that protect you from the increasing in expenses. And that's really kind of like what we're looking at. We're also looking at a very interesting, narrow window of opportunity in front of us right now. And that is in the $20 to $40 million range transactions right now. Usually you'd have a lot of institutional players playing in that space and REITs and so on. But all of these guys are right now sitting on their hands. And they're scared for their jobs because these are the decision makers. There's your W-2 employees.
Yeah.
So they're scared for their jobs right now. And that's the window of opportunity right now, that if you can find good group of investors and step into that level of play, there is really fantastic properties out there that normally wouldn't last a minute on the market.
Yeah. And what I hear you saying there is they're sitting on their hands largely because they don't know which way's up at this point in time, or is it because they've got, a lot of people have got dry powder and they're just waiting for potentially things to get worse?
So that's a really good point. And I just released a video earlier this week that talks about just that. So we're in the place where in the market cycle that we are racing to the bottom. On one hand, we have prices going down and cap rates getting better. But at the same time, the availability of money is also racing to the bottom.
Correct.
So for those of us that have been around in 08, 09, at the beginning of 2009, there were like fantastic opportunities. The end of 2009, there were unbelievable deals in the market, but all the lending sources, all the funding sources dried up.
Right.
Unless you're hoarding big cash reserves, I don't recommend waiting, because now you're in the moment of getting a great deal, but still getting a decent loan.
Mm-hmm.
And one of my mentors says, you marry the property, you date the interest rate.
You date the rate. Yep.
And that's really where we are right now. So I'd much rather lock a great deal right now with a decent loan to turn around and change it. Because if you look at, again, the last market cycle, the top was somewhere late 2006 before everything started blowing up. The bottom was end of 2009. So the drop was 3 years. The upside was all the way from 2011 to 2022.
Right.
So do you think the people that bought at the beginning of 2008 regretted it? No, they didn't regret the fact that it didn't wait all the way down to the bottom of the end of 2009. They still made a lot of money if they got with the property to the 2021, 2020, 2022 kind of time frame.
Are you a passive real estate investor seeking financial freedom? Well, today's market's unique and it's ever changing. Now is the time to get educated on how to strategically invest in commercial real estate for long-term financial freedom. Grab your copy of How to Passively Invest in a Changing Economic Environment. Go to www.mavericks.invest.com. You touched on borrowing. Expand upon that. How are you borrowing in today's environment?
Oh, that's a very interesting game these days because the landscape changes on a daily basis.
Correct.
So the only way we can stay on top of it is I talk to at least 3-4 lenders a week. And especially in the commercial world, every bank has those little buckets that they kind of have to fill. And every once in a while, one of those buckets have vacancy in it and they're going to have to fill it. And they're willing to do whatever they need to do in order to fill that bucket. So normally right now you have two kind of lenders. You have the lenders that still try to lend over prime. And prime is 8.25 today. So you're looking at interest rates anywhere from 9, 10, 11% interest rates, which is insane,
right,
compared to the lenders that lend over SOFR or lend over the US Treasury. So these guys are in the 6 to 7 range,
right,
which is much more palatable in the world of what we're doing right now. So knowing which lender lends on which kind of platform and what their appetite is, because a lender I did a multifamily deal with last month might not be interested in multifamily deals anymore, but they have an appetite for retail or they have an appetite for industrial. So like I said, they have those little buckets that they have to fill. So knowing which lender needs which bucket filled is a great resource of knowledge right now that can help you really build the right kind of deal.
Yeah. I like what you said. Understanding the nuances in the marketplace relative to the lender and their appetite inside physically, I mean, geographically, and then also physically inside of an asset. What buckets do they want to fill or do not want exposure to? Because you're right. Some of these people, I talked to a lender today, and I asked that exact question. He said, everything but hotels. We're tapped out on hotels, can't lend against the hotel, but we'll take anything and everything else.
Almost every lender I talk to right now says anything but office. I can't touch office. Right?
Yeah,
and
exactly.
But realistically, now is a great time to buy office because they're all hurting really, really bad.
Correct.
So you can get bottom prices. Like there was like a really big office building in LA that was like $80 or $120 million deal and it was bought for like 25% of value.
Sure.
Mostly because you can't get financing for these deals.
Yeah. Mostly because people don't want it.
Yeah. So this is really where I have a friend that what they do is they buy downtown office building and converted them to apartment.
Sure.
So change of usage and working with zoning. So this is where the opportunities are, where it's hard work and nobody wants to go to.
Yeah.
That's really where usually the opportunities are.
Yeah. When a passive investor is looking at a particular operator, what types of things should they be looking for when investing with somebody?
Okay, so that's a fantastic question because ever since Regulation D came out in 2012, 2013, there's a lot of sponsors that popped out of the blue.
Right.
And some of them are great and some of them are not so great. And the problem or the great thing, if you want to look at it that way, in the last 10 years is that everything was going great. So you can be a mediocre operator, but the market took you up and the rising tide lifts all the boats, right?
Mm-hmm.
And right now, though, what's going to really matter is how strong the operator is, because really only the strong operators are going to survive the next few years. There's no doubt in my mind about that. And we're going to flush a lot of the mediocre operators that got into the market in the last 10 years. That's one thing. The other thing is look for operators that put skin in the game and just take your money. Look for operators that own other assets in the same asset class that they're looking at. And look for operators that don't have a day job. So that's the kind of thing that we've seen a lot of doctors and lawyers and software engineers and so on stepping into the syndication world as sponsors. But when you have a group that has 2 lawyers, 2 doctors, 2 IT engineers and their wives, so you got 12 GPs, but none of them is going to drop the practice and go deal with anything if sometimes things happen, right? Something hit the fan.
Right.
And you got to go and do things, right? When we had COVID in 2020, and that was like, we took over management and created our own property management company in February 2020. Like a month later, the world exploded on us, right? And I had to drop everything and go on site. And I almost practically lived on site for a while because we had to get control over what was going on. Yeah. And we had to make sure that we take care of our investors and our own money in the deals. And we can't just let things go. But I could afford doing that because that's my business. I'm in real estate. I'm not a doctor that has patients or a lawyer that has court dates. I was able to do everything like that. So I'd say, especially in this market, find an operator that doesn't have a day job.
Yeah. So they find an operator, get excited about an operator, would like to do something with that operator. They get a deal put in front of them. How do they evaluate that deal? What are they looking for?
So when I tell people that are asking me that question, I tell them you look at 3 things. You look at the market, you look at the team, and you look at the opportunity itself. So the market is important. What is it? Is it a secondary market or a tertiary market or a primary market? What's driving the market? Now, again, it depends on the asset class. If it's multifamily, for example, which is the most common use case, is where are the jobs? What generate jobs? What drive jobs to the city? Like Dallas is a fantastic market because there's more and more jobs, opportunities creating in the market all the time. We just had Universal. They're working on setting up a new park and a few more very, very big employers coming to town. So the job market drives everything around it. But if all you have in the town is university or a theme park or just this or just that, or worse, if the job environment is declining, then it's a risky market. So the market is the first thing they have to look at, is how strong is that market and what's the outlook for the market. And a quick tip about this, what I like to do is I like to find the local news, whether it's the CBS or Fox or whatever, and look for the stories. And what is the theme around the stories? Is the theme about job creations and employers coming to town and new malls opening and new libraries setting up? Or is the theme about job losses and people leaving town and the sad stories? So what is the theme around the market?
Yeah.
And I'm looking for the strong market.
Yeah.
We talked about the team earlier, right? You want a strong operator with experience. That's not their day job, right? And then you look at the opportunity. Where's the meat on the bone? What are we looking at? What is the risk? How did that operator underwrite the deal? So if I'm looking at a property that needs to be 93% or higher occupied, let's say multifamily, and underneath that thing starts breaking, that's a high risk maneuver. I don't care if the entire market is at 95% or 96% occupancy. 3% is very, very easy, no matter what size of a property it is.
Right.
3% drop happens overnight.
Yep.
And not in your control. Now, we had a property across the street, had some people come from another place, and a brawl kind of rolled over into our property, and there was a shooting. It wasn't our property. It wasn't our resident. It wasn't even the neighborhood because they came from out of town. And then you have people get scared and they move, and 3% occupancy on 100 units, it's just 3 people.
Right.
So I would look at really the opportunity, how strong it is, where is the break-even point? And if it's not on the presentation, it's okay to ask the person that did the underwriting and say, hey, what's the break-even point? Where are we going to start losing money? Where are we going to start bleeding money?
Well, tell me this year, Joseph, what are you most excited about?
I think, like I said earlier, we have a narrow window of opportunity until we hit the bottom. And I don't know where's the bottom. The bottom can be next year. The bottom can be in 4 years. It doesn't matter. But I know we're getting close. We're past the peak. We're headed toward the bottom. So that window of where the biggest money is being made is when you buy on the way to the bottom, because that upside is going to be a lot longer and a lot better.
Let's do this. I want to move on in the final segment, what I call the final 4. What do you think holds most passive investors back from hitting their personal next level, whatever that happens to be?
Well, I think there is a trust issue, and that cannot happen overnight. So educate yourself, listen to podcasts like yours, and look at YouTube videos, talk to a few operators, talk to other passive investors that have invested with other people and get their experience so you can get over that trust issue, because trust is super important. If you're investing with someone you don't trust, it's never going to end well. So trust is very important. I think that's one of the things that kind of holds most people back. And then the other thing is people are worried about, what if I'm going to lose that? And my answer to that is, don't invest anything you cannot afford to lose. Every investment has a risk correlation with it. And for that same matter, don't put it in the stock market if you can't lose it, right? Even Apple can drop 40%. It happened before, will happen again. The great Enron went to 0. And everybody before that thought this thing was bulletproof. So if you cannot afford losing it, don't invest it. That's the other thing that I tell people. But once they get over that fear and they start building trust, then they can take that next step and invest.
What are you passionate about outside of real estate?
Real estate.
That's it, huh?
That's pretty much it. I ride motorcycles and I play the bass guitar, but real estate is what I'm really passionate about.
Yeah. Your favorite book is what?
Never Split the Difference by Chris Voss.
Chris Voss.
It's phenomenal. It's a life-changing book. It's my go-to. I read it at least twice a year. Absolutely phenomenal.
Iowa born, here in my backyard. So how about that connection there? Your favorite way to make an impact in the community?
So every year around Thanksgiving, like a week before Thanksgiving, we get some friends and family and vendors and everybody that wants to join. And we put a lot of our own money into it, but we also get some donations from other vendors and friends. And then we buy a bunch of turkeys and we buy a bunch of meal components, and we put together Thanksgiving meals, and we drive around and we hand them over. We had years when we've done over 150 of those. We've done as low as 60 something a year, but we're trying to do as much as we can every year. And it's not just the donation part, it's also the part where you walk up the door to somebody that does not expect you to come and you hand them over. And a lot of the time, because we don't just randomly knock on doors, we get a list of names from other people to help us out. And I'm very connected in the multifamily world. So I have friends that manage properties, and I ask them for, hey, give me the unit number of the people that you really know need that.
Yep.
And people just start saying, you can't believe I really needed this right now, and so on. And I try to take my kids with me. My kids are teens right now. So help them see that you can make an impact at the level of really a meal like this put together is about less than $20. And we do that a week before Thanksgiving. The turkeys are about $5 a piece by then. So within $10-12, we have a full meal for Thanksgiving for a family. And that impact is real. They see the faces of the people that actually going to enjoy that meal and how much they needed that. And I had a lady start bawling and ask if she can hug us. And it's like, it's a real world impact. I don't like just giving money to a random organization. I like to see a real world impact.
Joseph, this has been a fun conversation. You've got a unique perspective given the variety of assets you own and what it is because you're vertically integrated, the fact that you've got brokerage and property management under one roof. Tell me, for people, they want to find you, they want to follow you, they want to connect with you, where can they go? What should they do?
Yeah, so our website is simple, ebgtx.com. And my contact details are over there, my LinkedIn. I'm on every social media platform you can imagine. But our website, that's our brokerage website, and you can find us there. And I'm open for conversations with investors, with buyers, with operators. If I can help and bring value, I'm happy to.
No, wonderful. The link will be below in the show notes for everybody. Joseph, I appreciate your time here on the show. Thanks so much.
Awesome. Thank you for having me. I appreciate it.
You bet. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.